Let me paint you a picture. It's Monday morning, you need to get to work. You have two options. You book a private cab, full control, and goes exactly where you want. But it costs you 400 rupees. Or you take the bus. The same destination, same road, costs you 20 rupees. And here's the thing, the bus driver knows every shortcut, every signal, every route better than you ever will. Now imagine your money works the same way. You could try to pick stocks yourself, research companies, track quarterly results, time the market. That's the private cab. Expensive, time consuming, and fully on you if something goes wrong. Or you could pool your money with thousands of other investors, hand it to a professional who does this full time, and let them drive. That's a mutual fund. Same market, same stocks, but shared cost, professional management, and you don't even need to know the route. That's the big idea. Let's now go under the hood. Hey guys, I'm Adam and welcome to Big Brain Buddy. Quick question before we start. Does financial jargon make your head spin? SIP, NAV, XIRR, expense ratio. If you've ever stared at one of those words and quietly thought, what does that even mean? This series is for you. The series is called Small Steps, Big Wealth. We take one financial product at a time, strip the jargon out, and explain it like a real person should have explained it to you years ago. Today, we are going deep on mutual funds, what they are, how they work, and why they might be the single most important investment tool for most people. Let's get into it. A mutual fund is an investment vehicle that pools money from thousands of investors and uses that combined corpus to invest across a basket of securities, stocks, bonds, gold, or a mix of all of these. Each investor owns a slice of this pool, proportional to how much money they put in. And the pool is managed by a professional called a fund manager, employed by an asset management company or AMC. Think HDFC Mutual Fund, SBI Mutual Fund, Mirae Asset, and so on. Going back to the bus, think of the AMC as the bus company, the fund manager is the driver, and you are one of the many passengers who have paid a fare to get on board. You don't drive, you don't navigate, you just trust that the driver knows where he is going, and you share the cost of the journey with everyone else on the bus. The beauty of this structure is what it unlocks for small investors. With 500 rupees, you can own a tiny slice of Infosys, Reliance, HDFC Bank, and 47 other companies simultaneously. Try doing that on your own with 500 rupees in direct stock market. You can't. Now here's where we shift from the bus to our restaurant table, because this concept is better explained differently. Imagine 10 friends pool money to order a lavish dinner. The total bill comes to 10,000 rupees. Each person contributed 1,000. So each person's share of the meal is exactly 1/10 or 1,000 worth of food. Now the next evening the same group orders again. But tonight the chef used better ingredients. The portions are larger and the meal is worth 12,000 total. Each person's 1/10 share is now worth 1,200 rupees, even though they only paid 1,000 originally. That daily recalculation of what each share of the pool is worth, that's the NAV, net asset value. NAV is the price of one unit of a mutual fund calculated at the end of every trading day. If the fund holds stock that went up today, the NAV goes up. If the market fell, the NAV falls. When you invest in a mutual fund, you are buying units at the current NAV. When you redeem, you sell those units at whatever the NAV is on that day. One important thing, a higher NAV doesn't mean a fund is expensive, or a lower NAV means it's cheap. NAV tells you the current value of one unit. What matters more is how much the NAV has grown over time. That's your return. Back to the restaurant table. Imagine instead of one big dinner, your group decides to meet every month. First Saturday, same table, fixed contribution of 1,000 rupees each. Some months the food costs more, some months less. But you keep showing up and putting in your share regardless. Over time, in the months when the meal was cheap, your 1000 rupees bought you a bigger portion. In expensive months, a smaller one. But averaged out, you got a fair deal across the year without trying to time when the restaurant was cheapest. That's a SIP, systematic investment plan. Instead of investing a lump sum, you invest a fixed amount, say 1000 or 5000, every month automatically. On some months, the NAV is high, you get fewer units. On other months, the NAV is low, you get more units. Over time, this averages out your purchase cost, a phenomenon called rupee cost averaging. SIP also removes the biggest mistake most investors make, trying to time the market. You don't need to know if the market is at the top or the bottom. You just keep investing every month, through bull runs and crashes alike, and let time do the heavy lifting. You can start a SIP with as little as 100 rupees per month. That's literally less than a cup of coffee. Just like there are different kinds of buses for different journeys, a local bus, an express highway bus, an AC luxury coach. There are different types of mutual funds built for different goals and risk appetites. The first one is equity funds. These invest primarily in stocks. Highest potential return, highest risk. Best suited for long term goals, let's say 5 years and above. Within equity funds, there are further categories. Large cap funds invest in the top 100 companies by market size. Your Reliance, TCS, Infosys. More stable, less volatile. Mid cap and small cap funds invest in smaller, growing companies. Higher growth potential, but bumpier ride. Think of large cap as the highway express bus, faster and smoother. Small cap is the local bus through narrow lanes, adventurous, but you might hit a few potholes. Debt funds. These invest in treasury bills and bonds and other fixed income instruments we covered in episode 2. Lower risk, lower return. Suited for short to medium term goals or for the conservative portion of your portfolio. Hybrid funds. A mix of equity and debt in varying proportions. If you want growth but can't stomach full equity volatility, a hybrid fund gives you a middle path. The bus has both AC and non AC sections. You pick where you sit. Index funds. These don't have an active fund manager making decisions. Instead, they simply mirror a market index, like a Nifty 50 or Sensex. Whatever the index does, the fund does. Lower cost, no human bias. The bus follows a fixed GPS route with no driver discretion. ELSS, Equity Linked Savings Scheme. Equity funds with a 3-year lock-in that qualify for tax deduction under Section 80C, up to Rs 1.5 lakhs. The shortest lock-in among all 80C instruments. Same bus, but you have prepaid for the full route and can't get off early. Another category is liquid funds. Invest in very short-term instruments, sometimes as short as overnight. Almost as safe as savings account, but with slightly better returns. Parking money here for a few weeks or months before deploying it elsewhere is a very common strategy. This is one of the most debated topics in the investing world, and it maps perfectly back to our bus. An actively managed fund has a fund manager behind the wheel making constant decisions. Which stocks to buy, which to sell, when to increase exposure to banking and reduce exposure to IT. The manager is trying to beat the market, to deliver better returns than the index. For this skill, you pay a higher fee. A passively managed fund or index fund has no driver making decisions. It simply follows the index. If Nifty 50 goes up 12%, the fund goes up 12%. No more, no less. Because there is no active management, the cost is significantly lower. The big question though, does paying for the driver actually get you to the destination faster? The data across most markets over long periods says surprisingly often no. A majority of actively managed funds underperform their benchmark index over a 10-year period after accounting for fees, which is why index funds have become increasingly popular globally and now in India too. That said, in India's market, which has more inefficiencies than developed markets, skilled active managers have historically added value in certain categories like mid cap and small cap. The debate isn't fully settled here the way it is in the US. Nothing in the restaurant is free, and neither is a mutual fund. Expense ratio. This is the annual fee charged by the AMC to manage your money, expressed as a percentage of your investment. If your fund has an expense ratio of 1% and you have 1 lakh rupee invested, you are effectively paying 1000 rupees per year, automatically deducted from the NAV daily. You never write a check for it. It just silently reduces your returns. Active funds typically have expense ratios between 0.5 and 2%. Index funds are much cheaper, often between 0.1 and 0.5%. Over 20 years, this difference compounds into a significant gap in your final corpus. Exit load. Going back to the restaurant table, imagine you decide to leave the dinner early before the main course arrives. The group charges you a small penalty for disrupting the order. That's the exit load. Most equity funds charge 1% if you redeem within 1 year of investing. After 1 year, no exit load. It's the fund's way of discouraging short term trading. Direct versus regular plans. Every mutual fund has two versions: a regular plan, where you invest through a broker or distributor who earns a commission, built into a higher expense ratio, and a direct plan, where you invest directly with the AMC, no middleman, lower expense ratio. Same fund, same manager, same portfolio, just a different fare. Over long periods, direct plans can outperform regular plans by 0.1 to 0.5% annually, purely due to lower costs. When you join the restaurant group, you have a choice at the end of every meal. Do you take the leftovers home or do you reinvest them into tomorrow's bigger order? Growth option. Any profits made by the fund are reinvested back into the pool. Your NAV keeps growing. You don't receive any payouts. This is the better option for long term wealth creation because compounding works on the entire growing corpus. IDCW option, previously called the dividend option, now officially renamed to income distribution cum capital withdrawal. The fund periodically distributes a portion of its profits to you as a payout. Sounds attractive, but here's the catch: the payout comes directly out of the NAV. The fund's value drops by exactly the amount distributed. You're not getting any extra money. You're getting your own money back in smaller installments. Additionally, IDCW payouts are taxable in your hands at your slab rate. So, unless you specifically need regular income from your investment, growth is almost always the better option for long term investors. Just like we covered taxation on FDs and bonds, mutual fund returns are also taxable. But the rules depend on what type of funds you hold and how long you held it. For equity funds, if you redeem within 1 year, your gains are taxed at 20%. That's called short term capital gains or STCG. If you hold for more than 1 year, gains above 1.25 lakhs are taxed at 12.5%. That's the long term capital gains or LTCG. The 1.25 lakh exemption is a meaningful benefit for small investors. If your annual equity fund gains are below that, you pay zero tax. For debt funds, gains are added to your income and taxed at your applicable slab rate, regardless of how long you held. The old indexation benefit on that debt funds was removed in 2023. So the tax treatment is now simpler but less favorable than it used to be. For ELSS funds, since the lock-in is 3 years, all gains are automatically long-term, taxed at 12.5 above 1.25 lakh, same as other equity funds. Getting on the bus is easier than most people think. You can invest in mutual funds through several routes. Directly on the AMC website or app, this gives you the direct plan with lower costs. Through platforms like Zerodha Coin, Grow, or Kuvera, also direct plans with a clean interface that makes tracking easy. Or through a financial advisor or bank. These typically offer regular plans where the distributor earns a commission. You don't need a demat account for most mutual funds, just a PAN card and a bank account. KYC is a one time process and can be done fully online in minutes. For SIPs, you set up an auto debit from your bank account on a fixed date of every month. After that, it runs on autopilot. The money moves, the units are allotted, and you don't have to think about it until you are ready to redeem. So, to recap, a mutual fund pools money from thousands of investors, managed by a professional fund manager, invested across a diversified basket of securities. You buy units at the NAV. SIP lets you invest regularly without timing the market. Different fund types serve different goals: equity for growth, debt for stability, hybrid for balance, index for simplicity. Watch your expense ratio, it compounds silently. Always choose direct plans over regular. Choose growth over IDCW unless you need regular income. And understand the text rules before you redeem. The bus is already running, the seat is cheap, and the driver has been doing this for years. All you have to do is get on. See you in the next episode.